Good morning, this is Alan Buchanan, and I provide location advice to owners and occupants of industrial buildings in Southern California. Otherwise we wouldn't have. Alan Buchanan, Tuesday Traffic Tips.
Hey, good morning, and welcome to another edition of Tuesday Traffic Tips. This week, once again, brought to you by the good folks at Client Look and also the good folks at Reonomy. Make sure you schedule your free demonstration today. Hey, today's tip is a little known factoid about tax deferred exchanges. And as many of you know who deal in tax deferred exchanges, typically a buyer puts his money into an accommodator and then designates someplace between 1 and 3 properties for the upleg purchase to replace the relinquished proceeds. The little known factoid is that in 2 instances, you're actually able to identify more than 3 properties. And it's number 2 and number 3. If you take a look at the link that I placed below on tax deferred exchanges, you can identify up to 200% of the relinquished property value. So let's say your relinquished property was $20 million. You could actually identify $40 million in upleg properties. And you don't have to purchase all of them. You just simply have to purchase enough to satisfy the exchange. The second way you can identify more than 3 properties is called the 95% rule. And that suggests that you can identify as many properties as you want, but you have to close on 95% of them. And I've never seen that used in all my years doing tax deferred exchanges. Typically, it's choose 1 to 3. I've definitely used the choose more than 3, up to 200% of the value. Never used the 95% rule. So think about these. There are certain circumstances in which these are a wonderful application. Generally, if it's an all-cash down leg and you don't need to replace debt, then the 200% rule is quite advantageous. Alan Buchanan, make it a great week. Tuesday Traffic Tips.